Hello everyone, this is Jay, and in today's video I wanted to review a subscriber suggestion on an ETF to compare it to VGT, which it was very interesting actually, and the returns were really nice. And the other one that I want to review is Google, which I made a poll yesterday. I'm going to show the results of that poll, and then I wanted to quickly review it because it went on a dip yesterday, and it's looking very interesting for me. And I don't know, I'm even thinking about adding to my growth portfolio, just add a small position, maybe something like the Amazon one. But please, I really would like to know your opinion on these two topics from today in the comment section. And please don't forget to hit the like button and subscribe. All right, so let's go into the updates tab. And right here it is, the very first, the suggestion right here, AWIN 5819. And Awin explained, have you looked into TECL? That's the ticker symbol. Similar to VGT, what do you think? All right, so let's go right into the stock analysis tab, which I have it pulled up right here. Ticker symbol is TECL. The name of this ETF is Direction Daily Technology Bull 3x shares. I did not do much more research to see what's the company that provides this ETF, but it is called Direction, Direxion. So you can look it up in Google. The Direction Daily Technology Bull 3x shares is an exchange traded fund that is based on the Technology Select Sector Index. The fund provides 3x leverage exposure to a market cap weighted index of US large cap technology companies. This ETF was launched in 2008 and is issued by Direction. So you could go ahead, take a look at it, do a little bit more research also. I'll probably do some research because the results are pretty interesting, and you will see in a few. All right, so as you guys can see, in the last year, this ETF is up 151%. So this is definitely some great results. Assets under management for this ETF, $2.92 billion only. So it's not that big. It doesn't have that much in assets, but it has some very, very nice returns from what I see here. The expense ratio, now this is something that I'm not too happy about, I would say. The expense ratio is 0.97%, which is pretty much out of every $10,000 that you have invested in this ETF, you will have to pay $97 a year. So that's a pretty high expense ratio in my opinion, and especially for my liking. The PE ratio for this ETF is 51.16. That dividend 11 cents a year. I do believe that they pay once or twice a year only. But you don't go for this ETF for the dividend really, so we don't really need to make a decision based on that. Dividend yield 0.16%. Their last ex-dividend date was on December 21st, 2023. Payout ratio 8%, so they only use 8% to pay that dividend right there. The 52-week low was $26.27, and then the 52-week high, $80.53. So that's definitely a very big gap right there, which is nice. If you bought it at 26 and you were able to sell it at 80 each share, and you bought a good amount, you made a very good amount of money actually right there. Holdings, 76 holdings only. So let's go right into the holdings tab actually. And this is where I will need to do a little bit more research before I look into investing into this. But if you see right here, their top 7 holdings is Technology Select Sector in their index swap. So that I did not understand. I will need to do a little bit more research to see what these holdings are. But one of the ones that they have right here is Microsoft, of course, 16%. Apple is also in the top 10. So those are the only two stocks that I see in the top 10. Apple has 14% holding. This right here, the government cash, I'm sure they're probably trying to take some interest money. I think something like that. Nvidia is also in the top 15, 3.98%. Broadcom is in the top 15 also, 3.85%. And then you can definitely see some more company names right here after the top 16 pretty much. So Adobe, Salesforce, Advanced Micro, AMD, which is a very popular one right now actually. A lot of people talking about that. Cisco, Intuit. Intuit is another one a lot of people talking about, especially with taxes coming up. This one might go up in this next couple of quarters. Intel, IBM, Palo Alto, that's another one I see people mentioning a lot. Micron Technology. There's so many technology holdings on this one. I'm being a little bit bullish also on technology because that's definitely the future in my opinion. That's why I hold VGT. As you can see right here, the dividends, as I explained, 0.16%, 11 cents a year, a share a year. Payout ratio only 8%. Yes, the payout frequency is semi-annual. Dividend growth 125% last year. So that's some very, very good dividend growth. But it looks like if you see right here in 2022 they only pay once, and then in 2023 they pay 3 times the dividend. So as you can see, in March they pay 7 cents, in June 3 cents, and then in December 7 cents. But then if you see right here in 2021 they only pay 1 time, but they pay 27 cents a share, and in 2020 2 times also, 1 cent a share pretty much, and then 19 cents at the end of the year. But you don't go into this ETF for the dividend, honestly. But that growth, it looks really, really nice. So I put it right here on the stock analysis comparing ETFs in share price, and I have it right now for the last year. Like if you bought any shares a year ago, today a year ago, you will right now be up pretty much, let me see, 162%. Wow, you will have in 1 year 162% return if you invest into TECL. And then but if you invested 1 year ago into VGT, you will have only a 44% return. If you go into the 3 year, let's take a look at the 3 year. So if you could take this volatility right here, which I'm sure a lot of people get very nervous. Once it dips, people start saying, "Oh no, I gotta sell." Then definitely you should not be investing into this ETF, in my opinion, honestly. It looks like VGT has some volatility, but not as much as this TECL. But if you see right here, in pretty much like in 1 year, look at this, over 100% return. But it looks like this is one that you need to time it like very, very good, or maybe just hold a very long term and hope that you sell at a very good timing. So if you see right here, in the last 3 years, if you bought 3 years ago any shares, you'll be up 82% right now with TECL, and with VGT 43%. Now let's take a look at the 5-year comparison and look at this right here. Oh man, this ETF definitely went up crazy. And if you bought any shares that you bought 5 years ago and you're trying to sell them today, you will have a 612% return if you invested into TECL. Not sure if this takes the expense ratio into consideration. That might be something that will definitely bring down the return a lot, most likely. But 600% return in 5 years, that's crazy. And then VGT 187%. I do like VGT just because I feel a little bit more safe. I like their expense ratio. But let's take a look at the 10 years. This is crazy. Oh man, if you bought any shares you bought 10 years ago, you sell them today, you would have had a 3,375% return. So this ETF right here, crazy numbers, Please help me. Let's do some research. Um, Give me your opinion in the comment section. What do you think about this ETF? Definitely a very nice suggestion, honestly, from the subscriber, in my opinion. VGT would have had 500%, like a little bit over 500%. VGT is looking very small compared to this ETF right here. But if you see, VGT has been staying very consistent. And it does not have as much volatility as TECL, but TECL has some great returns right here. Please do not just invest into this ETF blindly. Do your research, of course. None of this is financial advice. But please also leave me your opinion in the comment section. As you can see right here, this is the big difference. The expense ratio, 0.97% for TECL and only 0.10% for VGT, which is a huge difference. But it looks like in returns, they give you a lot of returns, which it looks really, really good, honestly, in my opinion. And number of holdings, I think I explained it. 76 for TECL, VGT 315 holdings. So that also gives me that peace of mind. VGT is also from Vanguard. So, but one that you should look into, and I really appreciate that the subscriber suggested this one. I do like it, honestly. Well, I do like those returns. AWIN. I really like the returns. It definitely looks very interesting, and to have that big of a return. Oh man, that looks really, really good. Especially, maybe it's a cheap stock. Also, it's only like around 70 something, only around 70 something dollars. So, yeah, $70 a share. So maybe like $1,000 that you could put into this, and if you could hold it for 10 years, but and maybe get like a percent of return, a return like that. Wow, that would be crazy. But yeah, this one looks really, really good. AWIN, if you don't mind also paying that expense ratio. All right, so let's go right into the pool that I made yesterday, which it was Google, and I posted Google stock price went down almost 7%, but by the end of the day, it actually was down over 7%. So after announcing earning beats, I took the information from yesterday, which they finished with a fourth quarter EPS of 1.64, which they beat. They were projecting 1.60, if I'm not mistaken, $1.60. And compared to the EPS from the quarter four from 2022, which it was $1.05. What is your move or opinion on Google? So 63% of you said you're buying, which is definitely very interesting. And it definitely got me very curious, and I've been looking at Google for quite some time. I did some research before, and I definitely like the company. 6% of you said I'm selling, 6% of 49 votes. So that's less than a handful of votes. And then 31% say you're not interested. So, and I do appreciate this. One of the subscribers that commented was Christopher. He said it is almost within his cost basis. If it comes down a few more percentages, then yes, I'm going in hard. I got in at around $131. Wow, $131 cost basis, Christopher. That's really, really nice, especially right now. And I think Google is definitely a great company, in my opinion, also. And I don't think it's something that you will regret buying now and holding for like 10 years at least. I do believe that Google has been in business for a very, very long time. And I really, in my opinion, this is a great company right here. And it's very interesting. And I'm kind of thinking about adding on this pullback right now, honestly. Market cap for Google, ticker symbol is GOOGL. Name of the company is Alphabet. Market cap is $1.76 trillion. $1.76 trillion. Not billions, not millions, trillion. That's definitely a lot of money for that company. EPS, earnings per share, 5.80. PE ratio right now, 24.16. I do see it as undervalued, especially for a technology company with a PE of 24. I do like it. I do like it a lot, honestly. In my opinion, 52-week range, $88.58. 52-week high, it is $153.78. Honestly, anybody that went in at $88 or even lower from Google is definitely having a nice portfolio gain right now. Their earnings date, it was just announced. The analysts are calling this a buy. And in my opinion, well, let's continue to take a look. But as you can see here, in the last day, 7.5% it went down. As you can see right here, after announcing earnings beat, they were $151, and it went all the way down to $140 to $141. In Google right here, let's take a look at the financials, and you can see that revenue growing, which it caught my attention a lot. And this is when I was doing some research before, I looked at it and I'm like, wow, Google just continues to grow and grow. If you see, in 2014, they were only making $66 billion only, right? Only making $66 billion. And then now in 2023, $307 billion. If you see, it just continues to go up and up and up and up. And this company definitely looks very, very good. The earnings per share, let's take a look. As you can see, it just continues to grow also. They went from 2014, where they had 1.5, which is $1.05 earnings per share, to $5.84 earnings per share in 2023. So they have some very, very good growth in the last 10 years, pretty much 9-10 years. And then let's see the free cash flow right here. As you can see, free cash flow. They don't pay a dividend, so they don't use this free cash flow to pay dividends. They use it to continue to make the company better, which is good, and to pay down debt. So this free cash flow right here, I think they also have some stock compensation for their employees, which is definitely nice. I wish I pursued this career in technology. So in 2014, they have $12 billion in free cash flow, and as you can see, huge difference in 2023 to $69 billion. So this looks very, very nice. The operating margins also, as you can see, they stay very consistent, over 20% pretty much. And let's take a look at the balance sheet. Let's take a look at the total debt. Let's see that debt, how it's going. So they have a good amount of debt. They have $25 billion in debt. So they went from 2014, they have $5 billion in debt to $25 billion in debt. But this company has a lot of free cash flow also. So I know that they can definitely pay that debt and still stay with some cash. So right here, as you can see, $69 billion in free cash flow. So if they pay that 20-something billion dollars, they stay debt free, and they still have like another $40 billion on hand. So this company is definitely looking very, very good. Let's take a look at the forecast that the analysts are saying for this company. Which it is at a low price of $117, which it would definitely be really, really nice. If it went down to that price, I'll definitely be adding my eyes closed. I'll be adding to my portfolio with my eyes closed, and I'll probably deploy all the cash that I have right now on hand into this company to add a position. The average, it is $150, which is around the same price that it is right now. And the high, it is $180. Right now, as you can see, pre-market today already on Thursday, it is at $141. So it's going to start going up already. And I don't know, I think I'm going to be adding. Please leave me your opinion in the comment section. Are you adding into Google? 63% of you said yes. So I don't know. I think I am gonna be also jumping in there, maybe putting a small position, maybe like $40. Um, I don't know. This one looks very interesting to me. I do believe in Google. I do believe, as you can see right here, my portfolio, it is up 2%. To add Google right here next to Amazon, which Amazon would be also announcing earnings. I believe it is today. So I want to take a look and see how their earnings are. I'm sure they're going to be earnings. I'm sure they're going to be great because Amazon, they just had their fourth quarter, which it was huge, a lot of sales. So let's see what happens with the price of Amazon right now. I'm up 23% in Amazon, which is definitely great. I wish I put more money into it before. But Google is one that is really calling my attention. I just see it. I just think it's going to continue to go up and up from here, Google. But that's just my opinion, of course. And even if it goes down a little bit further and I start a position today, I'll just continue to buy and just DCA into that position if I add it today. But I'm really considering adding it today. So let me think about it a little bit more before the market closes and before I go to work. And yeah, so those two are the topics that I wanted to review today. Please don't forget to hit the like button, subscribe, leave me your opinion on those two topics, and I'll definitely see you on the next one tomorrow. Thank you. Disclaimer: I am not a financial advisor. This is for entertainment purposes only. Please do your due diligence and research before investing in the stock market. Thank you.